For 40 years, the United States exported factories and imported financial profits. Wall Street expanded, Main Street hollowed out. America became the world's consumer of last resort, funded by a reserve currency system that allowed unlimited debt expansion, unlimited deficit spending, and unprecedented financial engineering. The dollar's dominance created the illusion of structural strength, but beneath that strength, an imbalance quietly grew. Today, that imbalance is being exposed. The global macroeconomic architecture is undergoing a rapid systemic realignment. Sovereign policy reversals, global liquidity tightening, labor displacement through artificial intelligence, and foreign bond market normalization are converging simultaneously. Recently, the United States executive branch implemented aggressive unilateral tariffs, including a 25% levy on Canadian and Mexican imports and a 10% tariff on Chinese goods. These measures were designed to protect domestic industry and recalibrate trade dependency. However, the Supreme Court struck them down in a 6-3 ruling, citing executive overreach under emergency powers. The reversal was immediate. At the same time, the American labor market began flashing warning signals. Over 100,000 job cuts were announced in January 2026, the highest January total since 2009. Job openings have fallen to approximately 6.5 million, marking a multi-year structural decline from post-pandemic peaks. Households are now facing a dual compression. First, cyclical employment contraction. Second, structural purchasing power erosion. But the deeper question is more fundamental. How does a debt-based global reserve system survive when artificial intelligence permanently reduces the wage-earning labor pool required to service that debt? The transmission channels to the American household are tightening. Cyclical slowdowns are reducing hiring velocity. Corporate margins are compressing. Layoffs are accelerating. Simultaneously, artificial intelligence is projected to eliminate up to 50% of entry-level white-collar roles within 1 to 5 years. In a debt expansion economy, income generation is the engine that services mortgages, student loans, auto financing, and credit obligations. If the labor base shrinks, the servicing mechanism weakens. At the same time, inflation continues to operate asymmetrically. Wages rise slowly, assets rise faster. Measured against hard assets such as gold, the purchasing power of the federal minimum wage has collapsed relative to its late 1960s benchmark. Nominal wage increases fail to offset structural asset inflation. Bond yields are rising globally due to foreign normalization, particularly in Japan. As borrowing costs remain elevated, mortgage refinancing windows close. Credit card interest burdens expand. Real returns compress. Households are not only earning less relative to assets, they are borrowing at higher real costs. This is the compression phase of financialization. For 4 decades, capital allocation shifted away from production and toward financial engineering. Corporations borrowed to buy back shares rather than build factories. Banks expanded derivatives rather than fund industrial growth. Equity markets inflated valuation multiples under perpetual low interest rate regimes. The reserve currency system enabled this. A strong dollar made imports cheap and consumption powerful. But it simultaneously hollowed out domestic manufacturing by making American labor globally uncompetitive. The paradox of reserve currency dominance is simple. To maintain global liquidity, the United States must run persistent trade deficits. To run persistent trade deficits, it must consume more than it produces. To finance that consumption, it must expand debt. Over time, this dynamic favors asset inflation over industrial capacity. The recent tariff measures were not merely trade tools. They were implicit attempts to reverse financialization, to protect domestic production without openly devaluing the dollar. But reversing 40 years of capital structure cannot happen without volatility. We are witnessing capital rotation. Long-duration growth equities and over-leveraged financial sectors are facing structural repricing. Capital is rotating toward physical gold and silver, energy production, defense and domestic industrial capacity, commodity-linked assets. This is not a short-term hedge. It is a structural hedge against sovereign liability risk. While the United States financialized, China industrialized. Decades of trade surpluses were reinvested into manufacturing infrastructure, military capacity, global trade partnerships, alternative financial settlement systems. China accelerated gold accumulation. It reduced treasury exposure. It developed parallel payment systems to insulate itself from potential dollar sanctions. Meanwhile, The U.S. defense industrial base still depends on Chinese manufactured components for critical inputs, a structural vulnerability that limits geopolitical maneuverability. In a world transitioning away from unipolar dollar dominance, production capacity becomes leverage. Financial dominance alone does not. Systemic supply chain shifts do not guarantee equitable growth. For developing economies such as India, integration into alternative trade corridors may increase aggregate GDP. However, macroeconomic realignment historically concentrates gains among industrial and urban sectors, while stressing lower-income labor reliant on traditional wage channels. Global liquidity tightening disproportionately impacts emerging market debt servicing capacity. Structural transitions rarely distribute benefits evenly. The macroeconomic architecture rests on a Keynesian debt expansion model, requiring labor growth to service compounding sovereign debt. But the Bank of Japan is normalizing yields. For decades, near-zero Japanese rates funded the global yen carry trade, the backbone of global leverage. As Japanese 10-year yields rise, capital repatriates. Carry trades unwind. Volatility transmits across US, German, and French bond markets. Japan was the world's cheapest capital source. That era is ending. Simultaneously, central banks are diversifying reserves away from sovereign debt and accumulating physical gold at the fastest pace in modern history. This is not coincidence. It is systemic repositioning. Second-order effects are emerging. Synthetic digital asset markets have created massive derivative layers that dwarf on-chain supply. If forced deleveraging occurs, counterparty contagion could accelerate. There are also sovereign conflicts of interest emerging. During tariff volatility, financial entities reportedly acquired tariff refund claims at deep discounts. After judicial reversal, these positions yielded outsized returns. When transnational capital profits from policy reversal, sovereign credibility weakens. If foreign buyers reduce treasury purchases, the United States faces limited options. Explicit dollar devaluation, monetization of deficits, upward revaluation of sovereign gold reserves. Each scenario pressures the purchasing power of the American household. We are approaching a paradox. Artificial intelligence may create labor deflation. Monetary response may create asset inflation. Mass unemployment paired with rising asset prices. That is stagflation in a digital era. Historical capital rotations in the 1970s and early 2000s suggest prolonged stagnation in financialized sectors during structural resets. Real wealth preservation shifts towards scarce assets. The United States now faces a monumental task: rebuild industrial capacity, manage rising borrowing costs, stabilize labor markets disrupted by automation, preserve reserve currency credibility, all simultaneously. Transitioning from a centralized, rules-based order backed by treasuries to a multipolar system anchored in commodities will fundamentally alter the purchasing power of the American consumer. The curse of the reserve currency is not collapse, it is imbalance. And imbalances eventually force correction. Understanding these macroeconomic shifts requires disciplined analysis, not reactive headlines. At ETN, we focus on structural transmission channels, capital rotation, and systemic consequence modeling. If you value institutional-grade macro intelligence over emotional narrative, subscribe to ETN. Stay informed, assess risk exposure, and continue tracking the metrics shaping the new global economic order.